Welcome to the Academy. Okay, as expected, after our last recording on where do rates come from, a few inquiries about bootstrapping. So I thought I'd make a very quick video just to explain a few points, go through a couple of examples with you on those matters we were talking about in that previous video. A little bit of a warning, it's a little bit mathsy, but of course, whilst the maths is very, very necessary, it's not the most important thing. It's about proving what I was saying in that last recording. So without further ado, let's get into bootstrapping rates. We're going to start with the following information. And this is what I referred to on the where do rates come from recording as observable information. This is something we could observe. We've got three different bonds here with three different times to maturity, three different yields, effectively three different coupons and three different prices. We're using this observable information because these bonds are trading. There's buying and selling going on, so we have price discovery. And from those prices, of course, we can derive our yields, much as we talked about within that first where do rates come from recording. So what we need to do is to strip out from that observable information something that we haven't got available. We can't observe. And that's, in this example, going to be those zero rates and those forward rates. So we're taking the observable information, we're bootstrapping out all of this missing information. We're working out market expectations based on the information that we have. Whilst we're doing this, we have a belief that the 1 year zero rate in 2 years' time, and we're going to carry on in the same tradition as we did on that where do rates come from recording, and we're going to call this the 2 times 3 forward rate. We believe that rate should be 7.5%. Now, where's this belief come from? Well, please leave that aside for another conversation another day, because this isn't something I'm going to go into with this brief recording. It's certainly something we deeply discuss on our courses. When we look at various models to work out expectations, we look at growth models, inflation models, so on and so forth. But just for this simple recording, let's say we have a belief. Wherever it's come from, again, that's something to decide on another day. We just have a belief that that rate will be 7.5%. When we do our calculations, if that is not the case, we're going to see whether we have any potential trading opportunities. But let's start with the basics. This first bond, with its 1 year to maturity, has a yield of 4%. A yield to maturity of 4%. And if you recall, the yield to maturity is simply a weighted average of those zero rates. And if we're dealing with a 1 year period here, that would tell us that the 1 year zero is also 4%. If you think about the zeros as being averages of the forwards, then for a 1 year period, the forward rate would also be 4%. So nice and simply for the first year, forward equals zero equals yield to maturity. Let's carry on. Next thing we need to do is to work out the price of the 2 year bond. Now, this should be a fairly straightforward affair. After all, we did this again in that recording, where do rates come from, because we have the bond's coupon and we have the bond's yield to maturity. So all we'd simply do, as you see here, is to take that information and work out the bond's price. So we have those future cash flows, and to work out the present value of those future cash flows, we're using the bond's yield to maturity. In this case, it's 5%. So we now have our present values, and recalling that the bond's price is simply a sum of those present values, we now have the 2 year bond price. As simple as that. So there's another piece of information to fit in on our table. Now, the zero rate we need to work out. So think of it in another way. And again, forgive the maths here. It's not the most important part that we're dealing with here. And I'm going to show you how we can do it simply in Excel. But I just want to talk you through the long-handed way of thinking about this so we know what's going on behind the scenes of Excel. That bond's price that we've just calculated, we did so by using the yield to maturity. But again, and if you've missed this, please go back to that recording on where do rates come from. You know we can do this using our zero rates. We can discount those future cash flows using our zero rates. That first year's cash flow is $6. Let's divide that by the 1 year zero rates. What we don't have, and this is what we're trying to calculate now, is the 2 year zero rates. Because when we apply that to that second year's future cash flow, we can work out the present value. Now, it's all got to stack up. We know what the bond's price is. We've just established that by using that yield to maturity. So we're just trying to derive from that yield to maturity this 2-year zero. Another way to think about it, this bond's price that we have here that we've just calculated using the yield to maturity, well, it's made up of that first year's cash flow discounted, and here we can discount it using the 1-year zero, plus the second year's cash flow brought back to a present value using the 2-year zero. Another way to think about it, we can take that 2-year bond price, deduct from it the first year's cash flow, the present value of that first year's cash flow. That will give us a new number here, just over $96. And then we could think about going forward. We've just been coming backwards. We've just been discounting future cash flows. We could think about going forward, taking that sum of money, multiplying it by 1 plus this 2-year zero rate that we're trying to calculate. It must equal $106. When we find the right rate, it's got to add up. Otherwise, we have potential arbitrage. Okay, so let's rearrange the equation. Let's take that second year's future cash flow. That's $106. Let's divide that by the bond's price minus that first year's present value. That's what we established there. And this is going to give us the 2-year zero. So continuing on, that's the number we come back with. Now, of course, what we need to do is deduct the 1 because we added the 1 to those rates when we're doing the calculation. We take that 1 away, and when we multiply by 100, we come back with roughly 10.3%. Now, that's effectively a rate that covers 2 years. We can't simply divide it by 2 to get a 1-year rate because remembering these are not simple averages that we're working out here. We're looking at geometric averages, geometric means. We've got time series data, but again, leave that to the side. What we need to do is to take the square root. So we take the square root of that number, we deduct the 1, we multiply by 100, and we have now that 2-year zero rate of 5.03. Again, I'm going to show you the simple way we do it on Excel, but it's nice to see what's behind the scenes. Another piece of information for our table. So there is your 2-year zero, 5.03. If again you didn't see the where do rates come from recording, go back, please have a look at that because this is what we did back then. We can take that rate that we've just calculated. It's a 2-year zero. So we're going to square that and divide that by the 1-year zero rate. We deduct the 1, of course, and we now have our 1 times 2 forward rate. And we've just derived those from those zero rates. That is our 1 times 2 forward rate. So let's pop that in the table. 6.07. So we've just got 2 pieces of information left to discover. We're going to need to now calculate our 3-year zero rate. So have a look at the bond's price. It's $100. And of course, the $100 is made up of those coupons and the nominal value at the end to add to the last coupon. And again, we're going to use our zero rates. We have the 1-year zero. We've calculated just now the 2-year zero rate. What we need to establish is the 3-year zero rate. So we're going to do the same practice as we did before. We'll take the $100 price and we'll deduct from that these present values, the 1 year's present value, the 2 years present value, and we can deduct those to get a new result here, $88.79 roughly. When we multiply that by 1 plus this 3-year zero rate that we're trying to calculate, it must give us the end value or the final sum here of $106. Otherwise, again, we have arbitrage. So once again, take that third year's cash flow of $106, divide that by the price of the bond minus those 2 present values, and this is going to give us our 3-year zero. We come back with this as our answer. Thinking about it, take away the 1, multiply by 100, we come back with just over 19%. And again, we can't simply divide by 3, we take the third root. The third root of that number, then deduct the 1, and there we have our 3-year zero rate, 6.08%. Another piece of information for our table. And then finally, as we did before, we can take those zeros and we can work out our 2 times 3 forward rate. So we take the rate we've just calculated. It's a 3-year zero rate. So we, of course, cube that. We take that to the power of 3, and we divide that by 1 plus the 2-year zero rate of 5.03 squared. And that's going to give us our answer that we require. So for that 2 times 3 forward rate, we've worked out market expectations here are 8.22%. Okay, let's have a look at Excel and how we can do this perhaps in a more simpler way. Okay, so you see the Excel we have here, our table, and we've got all the information we need to fill in there in the yellow blocks. The first year was easy. We worked out our zero and forward rates. Well, didn't even work it out. You know, it's equal to the yield. So then the next thing we needed to do is to work out the 2 years bond price, the 2-year bonds price. And that's a simple case of, as you can see here, the functionality on Excel. We've just worked out the present value using our 2-year yield to maturity. That's, of course, the 5%. We have a time period of those 2 years. We have the payment of $6. That's the coupon on our bond multiplied by the nominal value. And then, of course, we have the future value at the end, the final value, which is $100. And with Excel working for us there, we've worked out the bonds price as quick as that. So nice and straightforward. Now, from that information, we can derive our 2-year zero rate. And that's a case, as we saw through the long-handed calculation on the slide, so much easier here on Excel. We're taking the second year's cash flow, $106. We're dividing that by the bond's price minus the first year's present value, and we're taking the square root of that. And that came back, as you well know, with a rate of 5.03%. To work out the 1 times 2 forward rates, then all we needed to do was to take the 1-year zero rate and the 2-year zero rate. And remember what we did. We had 1 plus the 2-year zero rate squared divided by 1 plus that 1-year zero rate. And that's how we derived our 6.07 1 times 2 forward rate. Then with that information, we proceeded on to look at the third year, the 3-year bond here, with its 6% coupon and its 6% yield to maturity, making, of course, the bond's price 100. That was easy. But again, you could use Excel to do this and prove it to you, but you don't need to. Same information we put in here. But if the coupon on the bond equals the yield to maturity, as we've said in that earlier recording, then the bond's price must be par. It must be trading at par. Okay, so with that information, what we're doing to work out our zero rate, again, we're taking the third year's cash flow this time. It just so happens to be the same as the 2-year cash flow on the 2-year bond, just to keep it nice and easy. We've got $106. We divide that by, of course, the bond's price of 100 minus this time we've got 2 lots of present values. So 2 years of present values, the first year and the second year. We take those away from the bond's price and we took the third root. And that's how we came back with that rate of 6.08%. And then lastly, it was a simple case of taking that rate that we've just calculated, taking that 3-year zero, adding 1 to it, taking it to the power of 3 and dividing it by 1 plus the 2-year zero to the power of 2. And that's how we worked out that forward rate of 8.22%. Okay, and that's using Excel to do this in a very, very simple way. As you can see, the formulas right there. And again, we'll let this Excel spreadsheet be downloadable from our website. So if that's something that interests you, please go ahead and you can play around with this if you wish to do so. And now we'll return to the slides and we'll be back on this spreadsheet very, very shortly. So through our exercises, what we've managed to do is to work out our forward rates. We've created here our forward curve. So we knew what the 0 to 1 forward rate was going to be. It's 4%, same as the yield, same as the zero rate. We worked out the 1 times 2 forward rate. That was 6.07. And then lastly, we worked out the 2 times 3 forward rates, and it's come in at 8.22%. But recall our belief, again, for whatever reason, we believe that this period, this 2 times 3 period, should actually be 7.5. So something doesn't look right. Something's not correct. We think the rate here, the forward rate, is too high for this period. So our belief is 7.5%. Now, we could simply look at the difference between these two periods, the two different bonds that we've got at stake here, the 2-year bond and the 3-year bond. And if the yield is higher than we believe it should be, because the forward rate is higher than where we believe it should be, that's suggesting that in relation to the 2-year bond, our 3-year bond looks relatively cheap. So we're expecting, of course, if our beliefs are to be met, that this rate, this 2 times 3 rate, is going to come lower. It's going to come down to 7.5%. Now, remember, we're not trading the forward rates in this example. We're trading yields. We're trading the bonds. Now, right now, we've got a 2-year bond that is yielding, as we've seen from the table, 5%. We've got a 3-year bond, which is yielding, again, the information we've got observable. The 3-year bond is yielding 6%. The spread between the two is 100 basis points or 1%. So again, based on our belief of 7.5% for that forward rate, then the suggestion is the yield on that 3-year bond is too high. So what we could do is simply buy the 3-year bond. And if we were holding the bond to maturity, then it would be no big deal. Absolutely no big deal, because we've locked in that yield. We've already established, according to our beliefs, wherever those beliefs have come from, but we have discovered that that bond looks too cheap. So if it's our intention to hold that bond until maturity, we'll buy that bond and indeed hold it until the end. If, on the other hand, we're just expecting this relationship to correct over time, and it's not our intention to hold the bond until maturity, then maybe we need to think of perhaps a less directional option. Because think of it this way. If you buy something because it looks cheap right now, what happens if it becomes cheaper? So your strategy is correct, your calculations, your beliefs perhaps are correct, but your timing is wrong. So you jump in at the wrong point. It's very much a directional trade. So perhaps less directional is to do something that is often referred to as selling the spread. We're actually going to trade the spread between these two bonds. It's a relative value trade. We're trading the differences in these relative values. So what we're suggesting is perhaps that we believe that 3-year yield will come down. Alternatively, the 2-year yield could go up. So we're correcting the relationship in this period of time. Now, if we do this together, it's less directional, because markets can go lower or markets can go higher or markets can remain exactly where they are, but the relationship adjusts until our beliefs are met. Now, I'm looking at this in a very, very simplistic way here, because to do this properly, we're going to have to get into all kinds of things like duration matching and getting the correct weights here. And that's a conversation that we have on a totally different recording. All right. I want to keep it nice and simple, but I want you to think about the fact that we believe this 2 times 3 period is not correct. We're not happy with it. Everything else, perhaps we're happy with. We're happy with that 1-year rate. We're happy with that 2-year rate. But it's this 2-year, this year period that begins in 2 years' time and ends in 3 years' time that we're not happy with. So if we were playing things very, very simply, and maybe we should just think about that. We think the 3-year bond is relatively cheap to the 2-year bond, so just buy it. Hold it until maturity. We have no other thing to worry about. But as I'm going to prove to you again, back on the Excel spreadsheet, we just have to see a change, a narrowing of this spread of 20 basis points, roughly 20 basis points. I'll prove it to you on the spreadsheet between those two bonds, and all of a sudden, our belief will be met. And again, this is slightly less directional. So we were only deciding to put this position on for a period of time until the relationship corrects, until this 2 times 3 period meets our beliefs, then we could perhaps get involved in both of those bonds. We'll trade the relative valuation between the two. Let's have a look at Excel. So once again, back on our Excel spreadsheet here, And we can see all of the information that we previously calculated. And through this information and based on our beliefs, we believe that this period, this 2 times 3 period, is too high. So from that, again, working back towards the yield, we're saying that this yield is too high. This bond, in relative valuation terms, is too cheap. So the obvious thing is to just buy that bond. Buy that bond. We're expecting that yield to go down. And if the yield goes down, what happens to the price? It goes up. And once again, if we're holding the bond until maturity, that's the simple thing we could do. We found something that's cheap, we just grab it and hold on to it. But if we're thinking in terms of, you know, market direction, etc., or maybe just holding for a limited period of time, there's further conversation to be had. And we will go into that further conversation on our courses. We certainly do that when we talk about where we get these beliefs from, because this is very key to all of this. Very key. So where are these beliefs firstly coming from, and then how can we transact in these things, perhaps correcting. But just to prove the point that I mentioned on the slides, when I said just an adjustment, just a slight adjustment in this spread between these two bonds for this period of time, this 2 times 3 forward period of time, it actually gets to meet our belief. So for example, if we take that yield on that 3-year bond, if that changes to 5.78, I'm just plugging in the number right now on the spreadsheet. Look what happens to the bond's price, and look what happens to the zero and the forward rate. Of course, it all changes. It's all connected. That's a 22 basis point change in yield on this bond has gone. If you look down to here, it's gone up to 101. And you can see here, the forward rates, the 3-year forward, is now meeting our belief. And that's a slight adjustment in the spread between the yields on these two bonds. It's gone from 100 basis points to 78 basis points. So hopefully this has been a useful exercise, just playing around with these numbers, just bootstrapping out the information. But the key thing here was just proving what I mentioned in that recording on where do rates come from. Taking observable information and getting from that, stripping out of that information that we don't have, because we need all of this other information for other exercises. This and a whole lot more we discuss further on recordings that we'll be releasing, and most definitely on our courses. So perhaps I look forward to seeing you there.